the biggest fear that we have at the moment in the UK is we don't have any real reason for external investors to back our economy.
All right, welcome back to another episode of the RLT Pivot Podcast, brought to you by our preferred partner, Trade Nation. We've got our co-host in the house today, Dean Bradshaw. How are you today?
I'm very good, Dan. Yeah, good week again, as always. How about yourself?
Doing fantastic. Yeah. For this episode, because it's a topic, there's so many different facets of it and just how it works in the overall economy, how it affects our current spending dollar. And then a lot of news with the UK having some issues, just a minor issue too, as far as the pretty much financial structure. So for this episode, I wanted to talk to you a little bit about inflation, and then kind of see what the difference is really from the US to UK, how you guys are handling it and what that means to you. I know here in the US, I would say that's the number one fear right now in the markets. Every time you listen to any talking head or analyst on TV, they're talking about inflation. Will Jerome Powell raise rates again? What the CPI numbers look like? Is it the same energy in the UK? Is it the same topic there as well, or is it other issues that are taking the shine?
Well, I think currently the shine is being overshadowed by the poor leadership of the country. So the Prime Minister who's in at the moment, they come out with a new mini budget that has backfired, and investors looked at the mini budget and couldn't see how the debt would be repaid. You know, everyone who knows how countries run, that countries have their own debt, and that's how they bring in capital for their country to pay for things. So it caused a huge spike in terms of the pound dropping to the lowest price it's been for 50 years. So the initial thought is, okay, what does the country do now? So before we even begin with inflation, Bank of England had to step in and started buying back their own bonds. And in order to help with the retirement funds that investors are now worried about, you know, their nest eggs are under threat. So that sort of settled the boat for a short period. And then last week, the Bank of England decided that they're only doing this as a short-term fix until last Friday, which again sent investors back into panic mode, causing the pound to drop again. So the biggest fear that we have at the moment in the UK is we don't have any real reason for external investors to back our economy, which is going to be very tough for us to respond to, especially since we've left the EU as well. So we're sort of getting what we asked for, and we're being isolated. So inflation is definitely there. Energy rates are soaring, like they are in most places. But for us, we now have to figure out, okay, how do we get external investment to pay debt, which is going to come in the cost of high interest rates, higher taxes, something that the government said they wasn't going to do, but they're going to kind of have to. Otherwise, we're being talked about as a submerging nation now. So
yeah, and we appreciate the help over here. You guys are really helping with our strong market that we've got going on here. Yeah, it's fun, but it's also crazy to watch how the entire macro picture works. So we have the U.S. dollar, which is probably the strongest ever, partly due to the pound just dropping like a rock and just getting absolutely hammered. But we have our own issues over here as far as inflation goes, and even a lot of the political, not to get too much into politics, but a lot of the political atmosphere around the inflation, and in terms of how a presidency is viewed or a political party is viewed that's in power, we have rates increasing like hourly wages increasing by 5%. But we have currently sitting with the last CPI, we're roughly about 8.3% of inflation. So even though it feels like people are making more money, it's still a struggle for people here in the U.S. to really see a difference in their pockets, right? 'Cause they're still losing net 3% every single year from what they had previous years. So I would say inflation is definitely one of the biggest issues, and we see it every single time a CPI number comes out where we're looking at that CPI because obviously the Fed, which isn't involved with the U.S. government, it's a separate entity altogether, but they control the financial institution, right? Their entire job here is to control, they want to keep about a 2% inflation rate, right? And we're way, way above it. We're hitting historical highs for inflation. And until that number comes down, they're going to keep raising rates. And I think that creates the risk-off type atmosphere because now money is a lot harder to borrow in the U.S.
Yeah.
Same thing if you're looking at the real estate industry here. If you were able to get a house, a mortgage for 3.5%, and just literally 3, 4, 5 months later, you're paying 5-6% on a mortgage, that could turn into another $130,000, $200,000, depending on the size. And it makes people want to pause and not purchase the house to really realistically deflate the demand for physical assets. With the UK buying back bonds, how would that help them? I guess two-part question. How does them buying back their own bonds help them to really stabilize the pound and the economy there? And then two, do you guys have any way? What is the best way for you guys to be able to fight inflation?
Dan, they're really two good questions. I wish I was a politician because I'd be able to give the ultimate speech. But if I'm honest,
if you were a politician, you would figure out how to work the entire answer without answering anything at all. Yeah.
Of course, and we'd be talking about the cow's milk or something like that, and they'd be like, "Yeah, that's it. You know, that's the solution. Sell more cow's milk." If I'm honest, I don't quite understand buying back the bonds, how that helped. I assume it's because the Bank of England have a reserve, and they was able to use some of that capital to pay off some of the debt that the country has in order to do other things. Maybe someone can chime in on the comments on that and broaden my minuscule brain. But in terms of how we fight this, is that in my opinion, and this is strictly my opinion, I know that you either sit on the hawkish or the dovish type of approach, but for me, I think interest rates have to go up, which is, I know people won't like that, but I think they have to. I can't see how else we can pay back some of the debt that we have, and taxes will have to increase. Now, there's a massive debate, and I'm not here to get in any political view on this, but that the higher earners should have a different or a higher tax, should be taxed higher than someone who's on low income, especially with the rate of inflation. Now, I'm not saying I think that's right or wrong, but that's something that I think the companies or the countries, I should say, should have to look at. What we have at the moment in the UK, we have a conservative Parliament, which again, I'm not going to tell anyone my political standpoints on anything because I don't want anyone to feel like I'm influencing anywhere. But they're very much for high net worth people, business owners, and helping them become more entrepreneurial. And some people who, not saying that they can't work or they choose not to, are the ones who get hit the hardest. So I think there has to be some form of fair balance between the two of that, especially when the country is in some form of recession, and everyone wants to avoid the subject. But
well, I do agree. I think raising the actual rates, nobody likes it, right? But we do have inflation just absolutely skyrocketing, and that the really only way to tamper the enthusiasm of inflation is to raise the rates. It's pretty much what the Fed here is doing. They are currently purposely trying to scale back the economy, right? Yeah. And they don't want to go to, so they do walk a fine line, and a lot of the policies that they put in place and the decisions they make, they don't really see the results right away. They're not sticking the economy in the microwave and hitting 30 seconds. When they raise a rate, it could take 4, 5, 6 months to really see it. And I think that's the trouble that the Fed's having as well is they could raise the rates, they're going a half point, 3/4 of a point, a full point each time to slowly bring that rate up. But just with the quickness of how inflation's actually increasing, it's a tough battle where they almost realistically they should come out, I think, and nobody's going to like this opinion whatsoever, but they should come out, raise the rate to where they need to. The entire market will collapse to an extent, but will recover a lot sooner. How they're doing it now, it's a slow peel, and they're just slowly trying to, and it's just going to be an extended period of time of just probably a lot of hardship for people, and unfortunately, a lot of people will lose a lot of net worth during it. But even with that, I like I said before, it's a risk-off type of economy. There's nowhere, realistically, there's nowhere safe to place money to really grow yield, except for some really extremely safe bonds and things like that. Yeah. If you throw it into the housing market, I mean, people are saying could be 25, 30% pullback in the housing market. Stock markets we've already seen, we're down 30, 35% in the stock market. Crypto, I don't know if that's still a thing, but crypto's been absolutely clobbered and is just kind of holding at Bitcoin's roughly around 1900. We'll see if that one could break some key levels or not, but you're getting killed in crypto, you're getting killed even in just holding cash. Now you're a victim to that high inflation again, right? So I think the winner that comes out of this entire thing, the person who comes out in the best shape is the one who loses the least money.
Yeah, no, I agree. And I think, there's obviously going to be individuals who are affected very differently from all the scenarios that could potentially happen, right? So I think we always have to be mindful that you have to, I'm very fortunate, even though I'm from the UK, I live in Spain, so I'm not overly affected by what's going on in the UK. I will be if the EU decide to follow the same sort of principles as the UK. But so there are people in the UK who are a lot worse off than me, and there's people in the UK who are a lot more better off than me and waiting for these opportunities, right? Because when there's a recession, then businesses become cheaper to buy, then because everyone wants to sell, they can't afford their business loans for whatever reason because of interest rates goes up. Houses, as you say, will have a drop off in 30%. Certain people won't be able to keep up with their mortgage payments, especially if they're on a variable mortgage, because they can go from paying 3% to 7% overnight or whatever they're just random figures I've thrown out there. But, and I think some people will be cash rich or ready to jump on opportunities. So whilst it's doom and gloom for some, it's not for others. And I think that's a way that, this is why there's controversy around this subject. And I think, again, that's where politics comes in. But for me, I think it's tough. I think we're in for a tough time. I think current position we're in terms of the economy, in terms of, again, inflation, interest rates, you've still got the political war going on between Russia and the Ukraine, and I'm not sure how it affects the US, probably not a lot, but I think I read somewhere, and quote me if I'm wrong, 25% of the world's grain comes from the Ukraine. So, and if they can't harvest that, then that's going to lead to famine. So, I've been exaggerated, but you know what I mean? So I think there's all these things going on. So I think it's going to be a long time before we get back to how we were prior to all this.
We've already seen wheat futures spike like crazy, never before.
Yeah.
Since a lot of the food in the U.S. is wheat based or grain based, and we're dancing around a short supply. The other thing is oil that we have. I know Biden tried to released some of the reserves that we have in oil, and now he's going back to dip into it again. And there's going to be a certain point, and OPEC just came out and said they're I know President Biden wanted for them to continue to produce more and more oil, and they came out, they're cutting 2 million barrels of oil a day. And we're only going to see a temporary fix with him going back in to hit the reserves again, because naturally we do have November 8th elections coming up, and it's a thing to do, but there's going to be a certain point where that's not an option, right? And I know I saw a report that I believe here in the U.S. at least, we have, as a collective, credit card debt has gone up to new highs for what people are actually holding. And you got people's savings account at lows. So and I think that's a temporary fix that at least American people are going through, where, okay, maybe it's a short-term thing. We have to, the price of gas has gone up, price of food has gone up. Every essential, every necessity that you need is in some way increased. And for them to cover that cost of that extra product, or just to the normal way of life, they're starting to have to throw that extra money onto the credit card, and hopefully it's a shorter-term fix, and they'll be able to pay it down later. But there's only the longer, and this is the problem with what the Fed is doing as far as the expanded rate over such a long time. The longer it lasts that way, just the harder it becomes, because it's just more debt accrues, and it's a tougher hole for people to dig themselves out of. So I still think, honestly, we're still in an early period of what we're seeing. I don't think the market bottom maybe it's in for this year. I'm not even positive on that, but going forward into the next 6 to 8 months, I think could get, like you said, I think it could get pretty rough.
Yeah, me too. So I think, what are you going to be doing? What's your plan of action for this?
I'm going to try to find a rock to hide under. See what happens.
I was going to say, mine's the same. I'm just going to hide in my office under my desk and just hopefully it will just all blow over. But
I think there's a couple things that I've been doing. So one, we have, I don't know if you guys have them there in the UK, or maybe it's a different name or something like that, but we have I-bonds.
Yeah.
Which I know people have been going absolutely crazy for, and it's been again a relative hot topic. Every 6 months the rate increases. So if you were to buy it today, or at the last day to really get it in for this current interest rate would be October 30th. So you're running out of time if you want to lock in that 9.62%. And then the new rate on those I-bonds for the next 6 months after that is going to be 6.48, I believe. But so that will give you about a 8.2, 8.3% interest rate annually, right? The one issue with the I-bonds is the cap limit. So the max you can put in is $10,000 per person, right. So $20,000 per married couple, and you can do an extra $5,000 through tax rebates if you had that opportunity to do so. But that's going to, you're still not really pacing inflation. You're kind of, it's an okay, but compared to all your other assets and things like that you have, it's a very minimal amount to really fight inflation and be able to make any type of progress, even to stay afloat. I think there was a Democrat and Republican who did submit a bill. I don't believe it was approved yet, but they're trying to increase the cap rate to about $30,000 per person. And again, things like that will help. The other thing too is just the regular T-bills and the regular bond market. You're seeing for the 30-year around 4% interest, which is fairly good. I mean, you're not keeping up with inflation, but it's better than also losing 30% in the stock market.
Yeah.
Right.
Yeah.
I think the one thing that will probably, and we could probably look at it 5 years from now, 10 years from now, in regards to the actual stock market, I think you're going to see, and I think you still see a lot of fear out there in the market. And I don't know if we're at the point where you just don't want to own stocks.
Yeah.
And I think we have to get to that point. I think to some extent if I get asked by an average person who I know has never had a stock or traded stock, if now is the time to buy the dip, I know it's not the time. It's not the time to buy the dip yet. When you see everybody on Facebook pushing every single stock out there, that's typically your sign to sell.
Yeah.
Right. So I think we need Apple to come down and Tesla. I'm watching those two very closely. Once we get to the point where nobody wants to own Apple and nobody wants to own Tesla, that's probably the bottom of the market.
Yeah.
That's when everybody's at max pain, and that's probably the time to buy. But historically, I'm still buying every single month. There's always something that I think has good value. Even some of the dividends, I talk about MO, Altria a lot. They're at roughly 8, 9, 10% dividend rates, depending on the day you get it. But you have good potential to build out some longer term positions. And I think we'll see. I'm not too crazy about tech yet, but there's some good companies. I was buying some Netflix, so right now at least positive on that. But I like the business as a whole. Yeah. If you have a longer time frame on things and you don't mind holding things for 10, it doesn't matter in the next 6 to 12 months if all the stocks are continuing down. as a long-term perspective, as a long-term investor, this is all you want things to drop. You want things to be extremely low in the market, because that's where you're going to be able to get a really good price and be able to, for the next 10 years, outpace the market. You're going to be able to get, you could buy a low-cost ETF and get 9 to 10%. But if you're able to buy individual names, and just over the course of the next 10 years, you're looking at 13%, you're looking at 20% on an annual basis on average, you're crushing the market. So these are extremely good times. But what I always tell people for the long-term investing is just your goal is not to just say, okay, I have $100,000, I want to buy things, right?
Yeah.
Because then it goes down another 20%, like Jamie Dimon says. Or I think he's actually being conservative. Let's say we go down another 30%.
Yep.
Nobody knows where the bottom of this market is, so you do have to continuously keep dollar cost averaging and buying and slowly get into your position. If I knew exactly where the bottom was, I'd be like, oh, $100,000 into the market today. This is it. Might as well. I mean, you know what? Take a second mortgage on the house. Let's just go all in. It's definitely the bottom. And not one person, I don't care how smart they are or who they are, not one person's going to be able to tell us this is the exact bottom for the market, right? And a lot of those people that missed the 2008 correction, they missed the COVID correction, they missed the dot-com bubbles, all of them, they're just, the fear was at the max pain, and they're like, nah, I don't want to own stocks. Stocks are just, they're not fun. And those are the times you're actually supposed to be buying. So again, I'm still buying every single month. I've set budgets that I'm looking to invest, but I realize that getting into the markets early, I'm probably not going to see a good positive return. Some of the stuff I'm buying, they're still holding up right now, but I don't expect them to. I know that if they come lower, there's still companies I like and want to keep in the portfolio. Yeah,
no, I agree. Well, my hands are tied a little bit because my portfolio I bought a long time ago, so I've seen it drop off. So there's not much I can do with that. But I decided, I made a conscious decision because, most people who know our community know that I don't just trade full time. Part of my business is that we try and buy other companies. So I decided to just go for that opportunity right now. I think that's where I am. If I had the financial resources to go and buy multiple properties when they drop 30%, that's what I would do. But the next thing down for me is to buy established profitable businesses that have motivated sellers that need to sell. And that's where I'm placing my investment and my cash at the moment. So coming away from the financial markets in its traditional sense, but it's still, that's where I feel like it's safe for me to, I say safe, nothing's ever safe, but for me, the probability I can invest in that, add value to the company and still be able to sell that on in order to keep my money from just falling foul to inflation right about now. So that's my strategic plan with that. And the other strategic plan that I've got with my longer term stuff is just to sit on my knees and pray every single day that at some point we go back up. So, yeah.
I think at some point your prayers will be answered. I think we do come up. Historically, the market is made and designed to increase value over time. So I'm pretty confident at some point, and I've heard some people put out it could be 5 years. I've got 5 years, right? If you're giving me 5 years to accumulate positions, accumulate companies, I'm all for it. That's fine with me. I'll have a insane return after that point. So the longer, actually, the better for a longer term investor that doesn't need the money in the next year, 5 years, 3 years, whatever it is. But I'm looking at that too. I'm looking at I'm excited for the real estate. The real estate only started pulling back, I think, a little bit, but I think it's going to be a good opportunity for the real estate market eventually. And a lot of people, again, the price is going to fall because the housing is more and more expensive. And with as far as the higher mortgage rates and things like that. But as the prices come down, I mean, if you have cash and you're ready to go and you don't need the mortgage, you're getting crazy deals. But even if you even if you don't have that amount of cash that's laying around, even if it's at 8%, 9%, whatever crazy rate the mortgage is, I mean, the realistic plan is we know this is a Fed-induced recession. Yeah. Right? We know that the Fed ripped the printer wire out of the wall and they're not funding the market anymore, right? They're not setting out the stimulus like they did back in 2020. So we know that, and we know that there's going to be a point where as soon as that inflation comes down and they can kind of maintain that 2% again, they're going to start to lower interest rates and things like that. So even if you have to get the house at that 8% because it's a great deal and you know nobody else wants it, that's still the best time to buy that real estate because everybody's waiting for these mortgage rates to come down. But you could always buy it and refinance as soon as those mortgage drop and you're making more and more profit. So if you understand how to kind of work the system and be smart with what you're doing and kind of think it through, there is a lot of opportunities in this market to just absolutely make a killing in these type of times. But again, it's opportunities come to those who are prepared for it and are looking for it. So continue looking, continue having the plan in place. So have a longer term view. It's not about what the market does today, tomorrow. It's what it does 5 years from now, 10 years from now. And if you're able to take advantage at the right time and you're sitting there at the right place, ready to go, I personally feel this might be one of the biggest opportunities we've seen in at least my lifetime. And I sat through 2008. I sat through COVID, obviously. I think we're setting up right now for a bigger opportunity than potentially all of those together.
Yeah, I totally agree. And even though I think, Dan, you and I are very similar ages, so I was around 2008 and COVID, obviously, but I don't think 2008, I wasn't educated enough to understand what was going on, really. I think I was even employed at the time. I even never had my own company then. But no, I was employed at the time, yeah. I was working for Barclays. So I remember that was the start of everyone having to be, made redundant and things, right? So, I didn't really understand the opportunity that was there then. And I think in the COVID times, well, at first we was all locked down in my house, which I just thought I was on a campsite at one point. I thought, I could start drinking. It's like Christmas. I'll start drinking early in the morning. We're not allowed to go out. What else am I going to do? Everything's shut down, right? So, and then anything that I invested in just went up. So it was a little bit of like a false economy at the time. I felt at the COVID time. So more luck than judgment, I would have said. But this time around, I feel like I am more prepared and I'm just waiting to pounce and deploy what we've been saving for a while. And don't get me wrong, 3 years time we could be having a podcast and I turn around and say I made the worst decision of my life then. But who knows?
I hope we don't have to
take that gamble.
And that's the thing. Like nobody knows honestly anything. It's just how can you? And for me, I am looking for. I have the long-term plan. I've had it for quite some time. I've been just adding some positions, some companies that I really like. They're discounted now, right? And I think we could drop further. So again, no matter how excited a stock looks, and like wow, one of the worst things people could do is look at a stock and go, oh, Roku was $500 before. Now it's $30. Yeah. I'm gonna buy Roku. Maybe it's a good decision. Maybe it's not. Do your own research. But just because something hit a certain price doesn't mean it will ever get back. I think there will be some companies in this market that just don't survive. Yeah. And I think there's some companies in here that will get completely overvalued or undervalued. Right. And I think the companies that have been around for a little bit, the companies that definitely make some money, the more stable companies, they're going to be okay. And I think those companies are a great opportunity to look into. And again, maybe not today. I still think maybe a little too soon. I think we do have a little bit more pullback ahead of us. But those are the type of companies that I'd be looking for getting into some kind of longer-term play and, again, just kind of withstanding the storm.
Yeah, totally agree.
If Google and Apple go to zero, we'll have a whole different topic for our podcast.
Yeah, I don't think we'll be around. I think we'll be on the spaceship with Elon, getting to Mars, starting again.
Give it another shot. Round two. Round two of humanity. Which I think we would. I don't know if we'd be humans at that point. We would actually, I think, be called Martians.
Yeah, sure. I wonder if there all the paperwork to qualify for that. Probably loads of red tape up there. But
I got to change my U.S. ship over to I'm pretty sure. It's a tough job for the post office too. Can you imagine? Mail a letter to Mars, it could be tough. All right. Unfortunately, we are just about out of time. We do appreciate you guys joining us each and every week for the Real Life Trading Pivot podcast. And we will see you next week for a brand new episode. See you guys later.